Investors around the world are looking for increased corporate profits, better returns, and lower risk. But unless you've been living under a rock, you have seen the signs of increased tension around the world. So with fewer and fewer choices, this brings more focus and concentration into one particular market. Can you guess what it is? You came here for the truth, so let me unveil that for you. Today we're going to look at where the risk is present. What are investors doing about it? Let's begin by taking a look at this chart out of Bloomberg showing us dollar is the new VIX. Well, according to the Biz, they say that the dollar replaces the VIX as the fear gauge. Very interesting to see what has happened with the VIX going back from the financial crisis up until today. But essentially what we're looking at here is the fact that the VIX was the thing to short all throughout 2017. It just kept going lower and lower and lower. And eventually, in January of 2018, something snapped. And then the VIX shot up really fast, instantaneously. All of those people who were shorting the VIX were punished by doing that. And you had the stock markets around the world tumbling. Global stock markets today, we are in August 2018 at the time of this recording. The VIX whole fiasco happened in January of 2018. And since then, global stocks, many of them are in a bear market. And it all happened because of some little silly thing like the VIX. Today, this VIX does not represent fear at all. So it is interesting to see that they are suggesting the dollar could be a better gauge. And as far as I'm concerned, I don't know if the dollar is a good gauge, but I can tell you right now, the VIX is not. All right? Look at that for yourself as time goes on. I think it's important. All right. We're going to look at asset allocation. I'm not going to cover all the details, but essentially what I wanted to show you here is the fact that more and more investors are putting money into US equities today. That means outflows from other countries. At the same time, they're putting more money into equities. They're also taking out of the fixed assets, and fixed income is not cool anymore apparently, so they're getting into US equities. And that could be good, could be bad. We'll have to see in the end. But ultimately, the more diversified a portfolio is, the more chance it has of weathering the storm. It's not about chasing growth. It's about weathering the storm. You can read the book, The Intelligent Investor, if you're interested in that. An older book, but definitely worth a read. All right. So that's that. I just wanted to show you this, but I'll cover more of this in a second here. In which region is the profits outlook most favorable or least favorable? And it's a little messy, but I'm going to show you this blue line right here. Throughout 2017 into 2018 is the US continuously going higher. Most favorable profit outlook. Definite increase here in what's possible within the US when money is leaving countries like Japan and it's going into a country like the US. Japan is a country that many consider to be very big, very stable. However, if the country owns, the central bank I should say, owns most of it, is that really stable? It's not really sensible to think that way. Japan owns 80% of the ETFs. 80% of the ETFs in this country are owned by the printing press. This number continues to increase. I believe, if I'm not mistaken, that 40% of the bonds in this country are owned by the central bank printing press. They are the top 10 holders of all the biggest stocks. This to me shows us that we have an issue on our hands, and unfortunately, it's not going to be dealt with. We have this, I cover it often. we're looking at the most crowded trades. I've been showing you this as time goes on. And investors constantly change their mind. But for the longest period of time here, the most crowded trade has been to be long on the FANG plus BAT, essentially the tech stocks. That has been this almost guaranteed trade for people. Buy the dip, so nice. There's more and more wealth being concentrated into fewer and fewer investments, and that historically has always resulted in disaster. 100% of the time. So if you look through here, this goes through all the months basically, going from long quality, okay, that's great for this period of time. You want to be long on quality. Then long US dollar. But then from this point on, pretty much middle of 2017 all the way through, it has been long NASDAQ and then long FANG and the BAT. So not even the NASDAQ anymore, because it's not about all the stocks. You only want those few. Even less diversity. It's gonna be such a wild ride to watch. I'm so excited for it. I mean, if you look around the world and you see some beautiful waterfalls, Niagara Falls. If you ever see Niagara Falls, it's quite an amazing sight. And in fact, many places around the world have these beautiful waterfalls. And they're beautiful to look at from the outside. But if you're right here, it's not going to feel so good. I assure you. The biggest tail risk right now, still remaining, is the trade issues. The trade issues that we are experiencing today are actually more concerning to investors than quantitative tightening, which is something I'm a little skeptical about, because I think it happens a lot slower. I think that's really, so the trade issues are on people's minds, are seeing it in the news more often. But the quantitative tightening is, in fact, the reason why this market is going to crash. It's not going to crash tomorrow, not going to crash today, but it will crash because of the central bank's quantitative tightening. The only reason it rose in the first place was quantitative easing, and as a result, you pull out the crutch, you collapse the system. What do you consider the biggest tail risk? This right here being trade issues, quantitative tightening is there as well, China slowdown, and so on, all right? Trimming the fangs. I thought this was funny because you can see not everybody thinks the same way. Large hedge fund managers cut their positions in some of the so-called FANG stocks that led the market higher last year. This particular company sold its stake in Apple before they became a $1 trillion company. In fact, a few of them did that. And they're basically saying, hey, but that was the right time, wrong time to sell. And that's true. It's pretty obvious that this company, when they've been talking about this, who's going to be the first company to $1 trillion, we knew that quantitative easing would have pushed them high enough. We knew that the retail investors would be chasing that as well. That is a fact. However, what we are not doing is lessening exposure to risk. People believe that the more concentrated their investments are, somehow that is less exposed to risk. However, that is not the case. Even if you feel so sure about something, it's always important to hedge your bets. That's what this article is about if you want to read it. All I'm going to say is that these individual companies are obviously not in the know. They are selling off. Perhaps they're just taking profits. I don't know what's going on the inside of this, but maybe they know something. The retail investor, the minnows, maybe they're ahead of the game. That's all. We're going to see. Household debt is absolutely unbelievable. This number has surpassed what we saw during the financial crisis. You can see it on the chart right here, going up to levels that are, this is truly truly embarrassing that the deleveraging that occurred just barely happened in 2008, 2009, into 2010, and so on, where people were going bankrupt and things. This had to foreclose on properties, had to, deal with hard times. And it wasn't hard enough because they didn't learn their lesson. Today we have the same exact problems. The same problems today, in fact, are much worse and exacerbated from the previous crisis. People are trying to double down and they're going to get burned. If they would only learn their lesson. Household debt and credit developments as of Q2 2018. Looking at this, come on, take your pick. Total debt, $13 trillion. Unbelievable. Looking at credit card debt, auto loan debt, student loan debt, and so on. All of this is at levels that they will never, ever be able to pay back. How is an individual ever going to pay back their student debt, number one, their credit card debt, number two, and if they got suckered into a mortgage on top of all of that, how in the world are they ever going to pay it off, particularly as the interest rates rise? Percent of balance 90 plus days delinquent by loan type. Ultimately, there are a large handful of individuals who have been delinquent. Now, we saw where the peak was in credit card debt throughout financial crisis just after that, and we can see, hey, look, it's declined ever since. What I would suggest to everybody is that they are using the equity in their homes to pay off their credit cards. This is a fact as far as I'm concerned. Looking around, we see that there have been ways that people can get around it, whether they are going bankrupt, whether they are using any sort of tax advantages to get them by, to get short-term loans to pay off. This is what's happening today. Ultimately, debt is increasing and people don't have the ability to service that debt. That is a fact, okay? I've shown you the charts before, shown you the documentation. That's what's coming. That's what's here today. And it's not going to change. And one day, this is what people don't understand. Well, nothing's happening. Look, $20 trillion in debt, $21 trillion in debt. We'll be at $30 trillion in debt, and the deficits will continue to increase, and it doesn't matter. But it does. When the trigger is activated, that's when the debt matters. All of a sudden, it starts to unravel. But you don't understand the monetary system and where all this fake money comes from. That's why you don't understand it. That's why you don't understand how it's going to happen. But all you need to do is sit down, read a few textbooks about this stuff. Learn about the creation of money. Learn where it comes from, and you would have a completely different opinion. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, it supports the channel. It's all you got to do. So, if you want the financial education that was not taught to you in schools, well, these two books have it all. You can check them out at the link in the description of the video. If you're more interested in the audiobook version, you can get that at themoneygps.com.